A very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, Chief Currency Analyst here at HYCM. A very good warm welcome to you. I'm just going to say hello to folks that are coming in. Hi Van, good to have you. Sammy, great to have you. Shwa, glad you can make it. Suneth, Vic, Akeem, Abe, lovely. Good to have a good number coming in. And just as other folks are coming into the webinar, just to outline what we're going to be going through. I'm going to be going through the dominant currency sentiment pair for the day, showing you guys how to recognize a dominant currency sentiment pair and then how to take advantage of it. Also going to show you the structure that I use for trading every single day, how you can use that. You'll find that in the handout section of the GoToWebinar control panel. There's a little overview, it says workshop handout, and if you click that, you will see when you click that the summary on how to use the workshop, how to use charts, looking at risk, looking at the outcome of your trade, etc., etc. So don't forget to use that facility. Without further ado, let's go on to our webinar. So the first thing to mention, we'll be looking at a special topic of how to trade interest rate decisions. We have the Bank of Canada interest rate decision coming up this afternoon. So I will be explaining how to generally trade interest rate decisions. They can be great trading opportunities in very specific situations. So I'll just run through how to trade that and how to get the most from it. As we start the session, the thing I want to draw your attention to is really this key principle. The key principle we're looking at in trading is pairing strength against weakness. Particularly in trading currency pairs, we always want to look back a strong currency against a weak currency. And the visualization I use, which is helpful and simple, is that if you imagined two arms having a wrestle, you'd favor the strong arm overcoming the weak arm. You'd look to back strength against weakness. Exactly the same way in the currency markets. We're looking to back strength against weakness. That's what we're wanting to do. We want to pair a strong currency against a weak currency. So what we're going to do today is exactly that. We're going to be looking at the strong currency versus the weak currency. And in order to do that, I'm going to just change our screens. I'm going to move us over to a different screen. Now, here is the Australian dollar, US dollar currency pair. Now, the reason we're seeing some upside in the Aussie US dollar pair today is there's three reasons. First of all, we had some positive news from the company Moderna, who had some positive vaccine trials. 48 or 46 people involved in their clinical stages showed some evidence of antibodies, which was a promising sign in terms of trial. That boosted risk sentiment. We've also had some news out from a company in Oxford in the UK, which has also expected to publish some very strong results on antibodies being increased as well as T cells being increased. So two lots good news for vaccine. That's boosted risk sentiment. We've also had a couple of Fed speakers out yesterday talking about the US needing to have more fiscal stimulus. So what we've seen in a very simple way is that the market is focusing on that risk on sentiment. Now, the way we know the market's focusing on the risk on sentiment is when we go through the equity markets, we can see that equity markets have been trading higher. So Asian equity markets were higher, with the exception of the Shanghai Composite. We've had European equity markets higher. We currently have S&P 500 futures trading higher. We also have bond yields trading higher. Copper prices higher. Crude prices are higher. Iron ore prices are higher. So the market is on a very typical risk-on footing. And whenever the market's in a risk-on footing, we expect the high beta currencies like the Aussie, the New Zealand dollar, and the Canadian dollar to gain in value. So we're seeing Australian dollar, New Zealand dollar, Canadian dollar strength. Also, we're seeing US dollar weakness. You can see the Dixie is down nearly 0.5%. That's short for the dollar index. If we just take a look at the dollar index here, you can see the dollar index is weakening. Now, the US has started a virtually unlimited program of quantitative easing. That should weaken the US dollar going further. We saw the US dollar strengthen at the height of the COVID-19 crisis, and the dollar has been acting as a safe haven currency. So it's been strengthening alongside the yen and the Swiss franc when risk is off, and it's been weakening alongside the yen and the Swiss franc when risk is on. So today, with risk being on and sentiment being positive, we're seeing dollar weakness. This dollar weakness is pushing dollar pairs higher. The major currency pairs are being pushed higher on this dollar weakness. So here's the reason for our Aussie US dollar upside bias. It's risk affecting buyers. Now, early this morning, I was looking for buyers from this 0.6975 region. Just taking a look, if we look at the daily chart, you can see on the daily chart that you see that price is forming into a symmetrical triangle pattern. You can see here. Now, these symmetrical triangle patterns can be powerful. Technically, this is a very typical continuation pattern. Usually when price forms into these triangular patterns, 1, 2, 3, 4, 5 touches becomes a legitimate pattern, and usually this is indication of further upside. So we have this consolidation on the daily chart and price breaking above that descending trend line, so a key resistance level. We also have, coming out of that descending trend line, a rectangle position. Now this rectangle, again, is a continuation position, and it's just ahead of that breakout. So the traditional thing these is when you have a breakout of these rectangles, you then expect a retest of them. So we've got a breakout. That breakout is confirmed now. We've been above the level for a couple of candles. You can see here we've got a couple of candlesticks above, and that's enough to confirm this upside bias. And typically price will return to these technical patterns. So we'd expect any return back to that 0.700 handle. Also big round psychological number. It was the breakout number. You can see the 700 level containing price here. Here price was short of it here, wrestled around it, breaking out. So we would expect this resistance level to now turn support. So from an intraday basis, we are now anticipating buyers from this 0.700 level. Now, where would you put stops? Stops can be placed back into the center of the symmetrical triangle. So anything around 6948 would be legitimate for stops, and any return back to this level here would be fine. But if we got a break and a close back into this level here, then that starts to make the trade unreasonable, and that is the basic way we'll be looking at trading back up to those recent highs. You can see here targeting around just underneath the 0.7050 handle would be an obvious target. If price proceeds from here back down, we target the recent highs as a potential first target. Now, a couple of other things to say. This is based on the risk tone being positive. However, one thing to be aware of in the market is risk tone has been changing on and off day after day after day. It's been continually flipping on and flipping off. So in other words, we need to be very much aware that risk tone could change. What are some of the things that could change risk tone? Well, there's tensions between China. If those US-China tensions get worse, if we see more tariffs being put on, or if we see more hit back from China against some of the latest moves, either to the US or the UK or any other country because of the Huawei issue. We also have the Hong Kong legislation. We have issues to do with the South China Sea. There's a number of bubbling issues. Now, the Australian dollar is traded as a proxy for the Chinese yuan. About 30% of Australia's GDP and the majority of its exports go to China. So if something's good news for China, it's good news for the Australian dollar. Bad news for China is bad news for the Australian dollar. So anything negative involving China hurts the Australian dollar. Be aware. Secondly, Brexit risks, they are going on in the background, have the capacity to change risk tone. European Recovery Fund, due to be discussed this week, and could potentially be agreed this week. That's why we've seen a lot of strength in the euro. Just take a look at the euro. You can see seen a tremendous amount of strength coming in the euro. That's on hopes of these European Recovery Fund being accepted, as well as positive risk tone weakening the dollar. We also have coronavirus cases, potentially more shutdowns. Any news of a deepening shutdowns could also harm risk tone. So there are some of the factors that would change the risk tone. I use what's called a dynamic stop loss. So in other words, if you are filled at that 700 handle, but then the risk tone changes, I won't wait for my stop to be hit. I would just close the trade out as quickly as possible. So that's the things to be aware of when we're trading Aussie US dollar. So that's the thing to look at. This is the rectangular pattern, test and move higher. We wouldn't want to be buying at highs. This price is too extended, and with the risk tone liable to change and the market conditions as they are, we want to wait for a pullback. Yes, that means we could miss the trade. Price could just keep moving up here higher and higher and higher. That's absolutely fine, because we don't want to be we want the higher probability trades, and buying at the highs is not a good practice to be getting into. So that's the dominant currency sentiment pair for the day. That is that principle of pairing strength with weakness. Don't forget, during this webinar, you can ask me any questions you want about any trades you're in, thinking of taking, any issues that you have or questions you have about the market. Just put your question into the question panel on the GoToWebinar control panel, and you know, I'll help answer that. I can see there's a couple of questions there already. Excellent. I will be dealing with those during the session as well. So thank you for looking at that. We are now going to go back to the main screen, and I'll show you how to no, we'll stay here, and I'll just show you how to trade interest rate decisions. Now, coming up, we have 3 o'clock UK time. It's now 1:40 UK time. So in 1 hour and 15 minutes, we will have the Bank of Canada rate decision. Now, the Bank of Canada rate decision is expected to be running at 0.25%. Now, that's expected, okay? I'll just run through the event so we know what's coming on. I'll just get rid of these other countries, and we'll focus in on the CAD. Now, so a couple of things to say. The bank's rate decision is, hang on a minute, yesterday to the next 7 days. I won last 7 days. What? There we go, that's what I want. That's better. Right, so we've got the interest rate decision coming up. Now, just looking behind, we can see that the run of data for Canada has been pretty good. Unemployment rate was 12.3%, only slightly worse than expected, but below the maximum expectations. Employment was good, a rise of 952,000, above the 700,000 expected. Excellent. Housing starts were good as well, higher and nearly as high as the maximum expectations. We saw the ID PMIs both above 50, indicating expansion for Canada. We also had trade balance, which came in nicely at a minus 0.68 billion trade balance, which was not as bad as the 3 billion expected, and it was better than the maximum expectations of a deficit of minus 1.5 billion. So the recent run, you can see that since July, has been a pretty good run of data for the Bank of Canada, but there are some problems for Canada. Number one, Canada is an oil export economy. And obviously, as we know, oil prices have been pressured. The US is the biggest consumer of Canadian oil exports. So with the US potentially slowing down due to rising COVID-19 cases, the demand for oil is likely to fall. As a result, the Bank of Canada has to juggle, a slightly better than expected domestic picture, and certainly in the last few weeks, against a more bleak outlook with the oil export market. So in making the rate decision, the expectations are that it will be unchanged. There is no policy change expected at all today. So that means the emphasis is going to be on the forward guidance. What is it that people are saying about not people, sorry, what is it that the Bank of Canada are saying about the future projections of their economy? Now, the Bank of Canada has a new governor, Governor Macklem. He's at the helm. And so just to be aware that there's going to be an interpretative job to do today. Is it bullish? Is it bearish? What direction did the Bank of Canada go in? Now, no one knows at the moment, but this is how to trade it. So if we have the Bank of Canada, and if they are bearish, if they're negative about the state of the economy, then we'd be looking at the Australian dollar CAD long, okay? Aussie CAD long would make sense if we have a bearish Bank of Canada. Also, Schwa, I can see you're looking about Euro CAD. If we had a bearish Bank of Canada, Euro CAD long would make sense, as well as Aussie CAD long. I'll explain why in a bit when I get to your question. If we have a very bullish Bank of Canada, if we see lots of Canadian dollar strength, that we see that the Bank of Canada is optimistic about the economy, then we'd look at shorting the US dollar Canadian dollar pair. Now, the reason we look at shorting the US dollar Canadian dollar pair, we're seeing US dollar weakness on the risk on tones, and if we saw a bullish Bank of Canada, we'd expect strength in CAD, which is US dollar CAD downside, and we'd favor shorting from that S1 support level at 1.3590. Now, this is dependent on the rate decision stroke forward guidance. So be aware of that. Now, how do you trade the interest rate decision? Now, this is something that's important, and definitely as a retail trader, it's something you really want to be aware of, and it's this. When you get surprise interest rate decisions, you can have huge moves in the market. No change is expected today. So that means if there is a change, it can really influence and move the market strongly. Get a rate decision that comes in at 0.00%. If there's a rate cut, if the interest rate is cut, that is weak for the currency. So an interest rate cut equals CAD weakness in this instance. So in that instance, you could trade something like the Australian dollar CAD long. That would be a trade that you could enter at market because you get a run of 50, 60, 80, 90 points. So look for a surprise. If we got a surprise hike, so say the Bank of Canada rate decision came in at 0.50%, then we'd expect US dollar CAD short. We'd expect to see the CAD really sell off strongly on that data. So if we got a rate rate hike of 0.50% or more, we'd expect the CAD strength. So we trade that against the US dollar CAD. So that's how you trade those interest rate decisions. And the simplest way to do it is to use a sell on stop or a buy on stop order. So in this instance, say you were expecting, there's two ways you can do it. Say you're thinking there might be a rate hike, you might get CAD strength, which is US dollar CAD weakness. Then you might just put a sell on stop order at like 1.3537, 1.3534. And then if when the data news comes out, then you would just be taken in and the price, you'd see the price shoot down. It would take out this low as well and be heading right down to that, 1.3500 level and below. Okay, so you can use a sell on stop, or you could just sell at market. So as soon as you saw the interest rate decision, if it was a rate hike, you could sell at market and take a large, take a good sort of 20, 30 plus points just on that spike, and then trade the retracement as well, potentially. So you have to be, that's how you would typically trade a surprise interest rate decision. Now, the key to this is a number of things. First of all, how much of it is a surprise? So today, any interest rate decision will see a strong reaction because it'll be a big surprise. The bigger the surprise, the better. That's what you're looking for. You're looking for a surprise decision. And the bigger the surprise, the bigger the reaction. The second thing, you need to be aware of current market conditions. So that's why you choose carefully which currency you trade it against, because you want to be trading strength with weakness, and you want to be trading weakness with strength. You don't want to be trading too strong currencies or too weak currencies. So you need to make sure you get the right pairing, and you also need to be careful on your entry. So you need to try to get as good entry as you can. A sell on stop can be an excellent, or a buy on stop. We have to be aware of with a buy on stop, if you're buying on stop and the spread widens, you could be taken into the trade early. If you're selling on stop, don't forget that the spread widens going into this interest rate decision, so you need to allow a wider stop. You know, you need to allow a sort of 40, 50 point stop to allow for a spread that could become very wide. Keep an eye on your spread as well. If the spread suddenly becomes too wide, i.e. sort of 10 points or, 10, 15 points or above, just skip the trade. So there's some of the key things you want to be looking at. I'll just now return to the main screen. And this is just a little screenshot you can trade, how to trade interest rate decisions. Got the interest rate cut equals currency weakens, interest rate increase equals currency strengthens. Now this is important decisions. They really make a big difference in the FX markets because obviously if a country increases its interest rate, that encourages capital inflows. Because as soon as a country raises its interest rates, current countries around the world and investors around the world want to benefit from higher interest rates. That's why the currency appreciates when interest rates increase. So when you have interest rates increasing, you have a currency strengthening. That's the basic relationship. Obviously, if you think about it in the bank, if you have your money in a savings account, you want to benefit from a higher interest rate. So if you can know, oh, hang on, if I move my money to a different country, I might be able to get interest rates of 5 or 6%, then you would obviously have to buy that country's currency in order to take advantage of those interest rates. That's the relationship. That's why you get capital inflows with interest rate moves. So I hope that's clear. Looking forward to the key events that we have. Key event we have is the Bank of Canada rate decision. We do have some other key data points as well. Just going to adjust the calendar, and we'll be looking at oil inventory levels, which are out at 3:30 UK time. So they are due out in about an hour. Let's have a look here. Right, so a couple of things here. The expectations are for a draw of 2 million barrels, okay? The private inventory data out last night is called the API private inventory data. It includes about 80% of the full inventory. That showed a surprise draw of 8 million barrels. A draw is a reduction, okay? So that reduction of 8 million barrels led to an increase in oil prices. That's why we've seen oil prices being supported on the day, okay? It's to do with this surprise draw of 8 million barrels. So a draw is expected today. So if we get a draw of around -4 million up to 8 million, that's not going to be a surprise today. That's been supporting the oil markets. What will be a surprise if we get a build? A build means more than expected. So if you get a build of 3 million plus, that will be a surprise, and that will be negative for oil. Don't forget, oil at the moment has got a couple of things it's talking about. OPEC Plus are meeting, and there's talks about the production cuts being either will they be extended or will they be reduced. The expectations are that the current production cuts will be reduced and that more production will come online. That's a negative factor for oil. At the moment, the draw in inventory levels and the risk on tone is a positive factor for oil. So oil is kind of, it's got a couple of push and pull factors going on. So what I would like to see today, for any shorts in oil, I would like to see a build in inventory levels. So what I'm looking at here, if I get a build in inventory levels above 3 million, and you get a build in weekly distillates above 2.5, and the weekly gas, if that comes in, if that all comes in greater than maximum expectations, that would be a short-term move down in oil. But the thing is, what you remember is that risk sentiment is on, which supports oil. So you'd be quickly looking to take profit and potentially initiating longs from a return down to these pivot points. We'll have to see what the data comes out, but obviously that's one issue. Just to let you know, the market is expecting a draw. So -2 million is expected. So anything between -2 and -8 million is not going to be a surprise to the market. So that may limit upside in oil, further upside in oil from here. A build would be a surprise, okay? And also don't forget, oil impacts the petro currencies, so that will impact the Canadian dollar. So if we see anything, you know, if we see oil heading up, if we see some positive data for oil, this will result in further US dollar CAD selling pressure, okay? If, on the other hand, we see something bearish for oil and we see CAD weaken, then we'd look at something like the Aussie CAD long. That's how we'd look at that. So here's just a quick summary for you. An unexpected build in inventory levels is bearish for oil. An unexpected draw in inventory levels is bullish for oil, but remember, a draw is expected. A draw is expected today. So it's the focus for today, an unexpected build. Risks that we have generally in the market are here. I've gone through them again during the session, so I won't go through them there. I'll just leave them on the screen. And I'm going to just start going through the question and answer sessions now with everybody, so you can see how this is going. Right. So right, okay. Okay, good question here from Mandar. How do you determine whether there is a rationality in price movement? Mandar, that is a great question, and it's such an important one, okay? So what I do every day before I come to the market, Mandar, I read up a session wrap. So I use a professional trading wrap, which explains the main events that's been going on in the day, okay? So for me, I came to the markets and I could see there's been positive news yesterday. The Moderna vaccine news was positive. We also had the Federal Reserve talking about fiscal stimulus. So I knew that was positive for risk, Mandar. Okay, that was risk on. I also looked at the equity markets this morning, and I'll just look at my Bloomberg terminal, and I can see, look, Asian equity markets are trading higher. Yields are higher across US yields. We've got yields higher across European. We've got equity markets trading higher. You can see that copper prices are up, crude prices are up, iron ore prices are up. This is a very bullish risk-on market. And we can see, look, European equity markets are currently 2% up plus on the day. Risk is on. What are the reasons, Mandar? Positive vaccine news. We've known, and I've said many times, that the situation we're in now is not a financial problem primarily. It's primarily a medical problem. Therefore, a medical solution is going to be embraced by the markets. That's why we've had this risk-on sentiment. In a risk-on sentiment, Mandar, we get Aussie, New Zealand dollar, CAD strength. Favor Aussie strength, and we've got US dollar weakness because of the risk-on tones for reasons we go. There's a rationality there, Mandar, you see? That's a rational reason for Aussie CAD upside. We then see that the Aussie CAD is breaking out of a ascending trend line. Look, triangle, technicals, continuation pattern, breaking to the upside. Any return back down to this ascending trend line or this short-term rectangle is suitable for longs. 700, big round number. It's all rational. Mandar, I hope you see. Some of this comes through time, some of this can be taught. So it's just a question of reading up and seeing what the rational reasons are for oh, I'm sorry, I've been sharing the wrong screen. Yeah, so you can see this is the rational reason for Aussie US dollar upside. Okay, so any return back to this 0.700 level is suitable for buying. Okay, as long as the risk on tone remains. Now, Mandar, it becomes irrational if all of a sudden there's news that says the vaccines are no good, the optimistic news was misplaced, and US and China are going to start putting tariffs on each other, then risk tone changes, Aussie sinks, but then there's reason then for shorting. Then that will become false break of a rectangle pattern. So, you know, that's the sort of different scenarios that we've got going on here. Okay. Shua, how about Euro CAD? Okay, let's just take a look at the Euro CAD pair. Euro CAD. Okay. You can see there's upside bias with Euro CAD technically, and the reasons for this are clear. We've seen a lot of Euro strength recently, Shua, on expectations that the European Recovery Fund is going to be accepted on the weekend. You can see here, Euro-US dollar has been just on a rip higher, and that has been boosting all Euro pairs, and that's why we've got up. That's why Euro is also higher. CAD is moved around with oil prices. So if oil is falling, then Euro CAD is moving higher. At the moment, we've got reasons for Canadian strength on the higher oil. We've also got reason for Euro strength on expectations European Recovery Fund has passed. So this pair at the moment I'd expect to be range bound because there's reasons for strength for both intraday. So in the sense of intraday trading, that's Euro CAD neutral. Now we've got oil data coming out, so that situation could change. But that is the situation that the Euro pair is in for now. Euro CAD. By Amanda, in addition to risk on and risk off mode, in case of trading an event, how to determine what extent the event has been priced in? Yeah, okay, Manda, a good question. So here you have the Bank of Canada rate decision. You can see that of 32 analysts, the maximum and the minimum expectation is 0.25%. So you can see here that is totally is priced in at 0.25%. If you get any deviation from this, you know it's not priced in at all. So you know there's going to be a strong reaction. With the weekly crude, you know that there's a -2 million draw expected. But we know that from the API data last night, it was an 8 million barrel per day draw. So we know a draw is priced in. Looking at the oil markets, you can see that oil has been rising higher because we're expecting that draw in inventory numbers. So you can see it's priced into the market. So what we're looking at here for the oil data is we're looking for a build. That's really what's going to potentially be of interest because the build isn't priced in at all, and that would be resulting in a potential sell. I hope that helps, Mandar. It's all about really on what the market is expecting and just sort of understanding it and knowing it, and it becomes intuitive. Oh, one more question. So how will we use deviation on the MetaTrader 4 platform? Could you show me some examples, please? Shra, yeah, your MetaTrader 4 platform will not have the deviations in the news. Those deviations are not there on the MT4 platform. So you need to be looking at a calendar. This is an icon calendar, and it gives me the minimum and the maximum expectations of what's going ahead. Feel free just to take a screenshot of this so you can see the minimum and maximum expectations coming up. Yeah, Mandar, somewhat. Yes, it takes time. Keep coming along to these events on the Wednesday, and I'll keep explaining them to you as they materialize one by one. Like another good example is the European Recovery Fund. So look, we can see here that the euro is being bought, you know, descending trend line. We're breaking out of this descending trend line, moving higher. And the reason that euro is moving higher is on anticipation that the recovery fund is accepted. So you can see here that the market is pricing in for the weekend European Recovery Fund being accepted. If it's rejected, then all of a sudden this recent rally we would expect to fall back into this trend line and maybe resume a bit of a downward trend. So that's something to be looking out for as well, particularly coming into the weekend, because the market's pricing in this recovery. Sometimes you can just sort of see it happening in front of your eyes. Yeah, that's great. Yeah. Okay, so here's just looking at, as we come to close, I've gone through the questions for today. Oh, sure. Oh, any expectation Euro Recovery Fund won't pass, from Shwa. The expectations are that it will. There's 5 countries that are opposed to the idea of grants. It's Austria, Denmark, Sweden, Hungary. Sorry, Austria, Denmark, Sweden, Netherlands, and Finland. Those 5 countries, they're shorthand called the Frugal Four. I know there's 5 of them, but they're still shorthand for them as the Frugal Four. And they are opposed to grants. They would much rather that struggling countries like Italy, like Greece, like Spain, they'd much rather that they were given grants, given loans rather than grants. So those 5 countries could jeopardize the fund being passed. Now, the expectations are they won't, or there'll be some compromise that it will still pass, but it's possible. So there is a chance the Euro Recovery Fund won't pass, but the broad expectations is that it will pass, if not now, then at some point in the future. But there is potential for Euro Recovery Fund not to pass. And remember, Shwa, this will be over the weekend. It'll be decided on Friday and Saturday. So as a result, FX markets will be closed on Saturday. So there could be a lot of volatility over the weekend. So it's something you definitely need to be aware of. Okay. Hope that helps. Just returning back here, don't forget risk on markets, risk off markets. We're seeing risk on markets at the moment, and this is what we get in a risk on market. We get weakness, yen, Swiss franc, US dollar, strength, Aussie, New Zealand dollar, CAD. We also get strength in oil, strength in copper, bond yields rising, equity markets rising, and the VIX falling. The VIX is the volatility index. I'll just show you the VIX. It's a very helpful tool, the VIX. You can see here, this is the VIX. It's the volatility of the S&P 500 market. Basically, it's used as a fear index. When the market's feeling optimistic, the VIX is falling. When the market's feeling scared, the VIX is rising. VIX falling at the moment is a good sign. It's saying that the market is settling into that risk-on area. We can see here that the market is just settling in now for some, there's some profit taken as VIX traders have moved down back into this lows here. Okay. Yes, sure. You're very welcome. And don't forget, attend this webinar, because this is your opportunity to pick and this is your opportunity to find out, lots of tips, lots of tricks, lots of expectations that are coming ahead. So please do attend this webinar. A number of us have been doing it for quite some time, and getting benefit week by week. So we're very happy to have you guys keep joining, and thank you very much for your time. So thank you, everybody. Thank you very much for attending. I hope you have a good session and that you are ready for the Bank of Canada's rate decision later, as well as the oil inventory report coming. That's great. That's super. That's good to hear, Shwa. Okay, thank you very much, everybody. Aaron, good to see you again. Akeem, good to have you. Salman, Salvatore, Sammy, great to have you as always, guys. Van, Tribuvan, excellent. Thank you very much for attending. And if it's your first time here today, a special welcome as well. And I will say good afternoon to you. Thank you very much now, and goodbye.